Look at this official public offering document. By early 2019, the We company was preparing to hit Wall Street with a valuation of $47 billion. They were not pitching themselves to investors as a traditional real estate firm. Their prospectus bypassed standard business metrics entirely, leading with a stark, cult-like dedication to the energy of we. 4 years later, in November 2023, that energy dissipated. The company collapsed into Chapter 11 bankruptcy, crushed under the weight of $18.65 billion in debt. The popular explanation for this failure is that the global pandemic and the permanent shift to remote work destroyed the viability of the entire co-working industry. Except, at the exact same time WeWork was filing for bankruptcy, their older, quieter rival, Regus, now operating as IWG, was pulling in a record £3.3 billion in revenue and expanding profitably across 120 countries. The co-working model is highly lucrative when executed correctly. WeWork died because of a toxic collision between an entirely rigid real estate strategy and a reckless venture capital mandate. The entire flexible workspace industry runs on a concept called arbitrage. Operators sign long-term leases for empty office space at cheap rates, divide that space up, and sublease it on short-term contracts, charging a premium for flexibility and design. The profit lives in the spread between those two numbers. Regus makes this math work by keeping their capital requirements extremely low. They focus on suburban markets where rent is cheap, and they rely heavily on franchise agreements where the property owner takes on the risk of building out the space. WeWork took the exact opposite approach. They targeted the most expensive urban real estate on Earth, signing completely inflexible 15-year lease obligations and paying for all the lavish renovations themselves. This chart from WeWork's filings shows supposed cost savings of up to 66% for their members compared to a standard lease. They manufactured this comparison by presenting themselves as a software platform, masking the staggering physical costs required to keep their own buildings open. The physical reality caught up to them quickly. By mid-2023, WeWork was forced to spend 80% of its massive revenue solely to cover its rent and interest obligations. Applying software terminology to a traditional business does not grant it immunity from the gravity of real estate unit economics. WeWork's reckless execution was heavily driven by its primary backer, SoftBank's Vision Fund. Armed with $100 billion, the fund roughly equaled what the entire U.S. venture capital industry raised in the previous 2.5 years combined. To attract that immense pool of money, SoftBank agreed to a highly unusual structure. They guaranteed outside investors a 7% preferred annual dividend on their capital. This locked the fund into a payout of $1.7 billion every year. Faced with a ticking clock, the former Deutsche Bank debt traders managing the fund had to deploy capital immediately in massive bursts to outpace their liabilities. SoftBank routinely pressured startups to take significantly more money than they asked for. By writing oversized checks, they intentionally crowded out other, more cautious venture firms from the capitalization table. This unnatural influx of cash came with strict instructions: conquer the global market instantly, prioritize rapid physical expansion, and abandon standard financial discipline. WeWork was the inevitable, explosive byproduct of a poorly structured venture capital fund desperate to outrun its own debt obligations. When the pandemic hit, it functioned as a brutal economic stress test. As urban centers emptied out, WeWork's occupancy rates plummeted instantly. Regus absorbed the exact same shock and grew. Their suburban, franchise structure aligned perfectly with a workforce that suddenly wanted flexible office space closer to home, avoiding downtown commutes. WeWork had absolutely no room to pivot. They were pinned down by $16 billion in long-term urban leases. Without steady membership fees to cover the spread, the company was economically paralyzed. The financial wreckage was absolute. WeWork's equity was wiped out in bankruptcy court, and SoftBank was forced to absorb a humiliating multi-billion-dollar write-down on their investment. Limitless capital and visionary branding cannot overwrite basic business physics. When financial engineering ignores the actual cost of operating, collapse is a certainty.